Good afternoon, traders. I hope you're all doing well. Welcome back to Traders Hub YouTube channel, where we post trading educational content and weekly technical analysis. With you is none other than Maalim Mathman, head trader at Traders Hub. Yes, and without wasting time, let's continue with where we left. And as usual, we are going to start with a little bit of recap. Yes. If you all remember, on the episode 2, we got to learn about how we can set up our charting software. And I think specifically, we opened a MetaTrader platform, MetaTrader 5, and set it up. But on this chapter, we're going to dive deeper and set up TradingView, our TradingView charts, because that's where we mostly do our technical analysis. Yes, and if you can remember, on our last episode, we also learned about candlesticks and the dynamics behind them. Yes, we also talked about wicks, bodies, candlesticks, formations, and reading what a candle tells us. Yes, we also mentioned and touched on the fractal nature of the market. And we also got to discuss the different time frames and how we can set them up on your chart. Yes. And today on our episode 3, we are going to, like I mentioned earlier, we are going to set up our TradingView chart, because that's where we mostly do our technical analysis. Yes, we are going to expound a bit on the markets and supply and demand, which dictates what the market does. Yes, we are going to top it with putting labels on the chart. Yes, because as usual, technical analysis is the science of making a sense out of a chart. Okay, and so how do we make sense out of the chart, and how do we analyze the chart? As simple as it is, we just put labels on the chart and anticipate where next the market will be heading to. And yes, we are also going to learn about the dynamics of an uptrend or a bullish market, and we are also going to learn about the dynamics of a downtrend. Yes, and got the foundation. Now it's time to get on the technicals. Yes, what is technical analysis? Technical analysis is the study of price movement on a chart to predict future market direction. Okay, it uses tools such as trends, support and resistance level, chart patterns, and indicators. Yes, it also uses tools such as it uses tools such as the trend to identify the direction of the market, point of interest, and entry and exit area or trading opportunities. Okay, traders analyze historical price data because they believe market behavior often repeats itself. Yes, I think we can see the pyramid and the hierarchy of trading. At the bottom of trading or at the bottom of technical analysis, it's bias and direction. Yes, we usually identify the direction on which the price is trending to, or the bias. Yes, the general bias, be it bullish market or bearish market, because we can only have two directions. Yes, we can only have three directions. Either we are trending bullishly, or we are trending bearishly, and last but not least, consolidation. Okay, and after identifying the direction of the trend, the technicals help us to identify our point of interest. This is where we are looking to find maybe potential entry setups or potential entry criteria, and it is on this zone where we wait for the price to come. Okay, yes, and at the helm of the pyramid of the technical analysis, we have entry model and exit models. This tells us exactly where we should be entering and where we should be exiting, where we should be exiting if the price went on our direction, and where should the market exit us when the price goes against us. Okay, yes, the markets. What is the market? I think many of us, I think, ask ourselves, what really determines the price of a stock market, a commodity, or even a forex pair? A marketplace is where traders or investors come together and bet on their opinion whether an asset is underpriced or overpriced, cheap or expensive in other words, and low or high. It's a constant battle of buyers and sellers, nothing else, and the bigger group wins. Of course, this is just like a normal a normal bid. The one with bigger group, the one with strength, the one who puts more money wins on this, and the one who has a smaller group, who has less strength, loses. Okay, yes, price is driven by the law of supply and demand. The more demand for an asset, more people want to buy it rather than sell it. The higher the price will, as simple as it is, the more there's a demand for a specific asset, it simply means that more people want to buy it. Okay, and for that reason, the price of that asset will increase in price or will appreciate in price, and the vice versa. When there is more supply of an asset, people tend to sell it, okay, and refrain from buying it, and that causes the price to go lower, or it pushes the price lower. Okay, this is the most important law of the market, the law of supply and demand. Whenever the demand outweighs the supply, price will surge or will appreciate in value. Okay, and whenever whenever there's more supply in the markets than demand for it, that asset will decrease or depreciate in price because of the nature and the law of supply and demand. Yes, who drives the market? I think we discussed this on the first episode of Introduction to Forex Market. At the top of this financial market is BFIs. These are banks and financial institutions. Okay, they have most power, tons of money, and knowledge and infrastructure to push the markets. Okay, I think we gave an example of these international banks. We have JP Morgan. These are banks which control over 2 trillion of assets in these markets. Okay, there is we talked about JP Morgan. Yes, we talked about hedge funds. I think we talked about Bridgewater, a hedge fund controlled by Ray Dalio. Is managing over 150 billion in assets. Okay, so it is these banks and financial institutions, big financial institutions, that have most powers and tons of money and knowledge and infrastructure to push the markets, be it bearish or bullish. Okay, And at the bottom of this, we have retail traders who are us and have almost no say for the price. Okay, because the size of our bets is merely, yes, it's just a drop in the ocean. Okay, so our goal is to follow the big bank and financial institutions and their footprints where they think price will. Okay. Yes, for us to really understand the dynamics of supply and demand, yes, you have to bear with me and take this chart for as it is. Yes, and we are going to start with this level where we label it as this is expensive, okay? Meaning that there is more supply than demand on this area. And for that reason, you can see that the price is depreciating in value, okay? And slowly it is depreciating, but on this level it is still expensive, not cheap enough yet. And once we go to this level, it is now cheap, and you can anticipate that it is from this level that the price will move higher. Okay, and so this is our demand area. Okay, this was the previous supply, this is our current demand area. Okay, like I mentioned earlier, I think it was on episode 1 or 2, a price rarely, it never moves in a straight line. Okay, it moves in sequence of waves. Okay, higher, higher, high, higher, low. Okay, and since we've identified this as a cheaper area, you can see that price is now slowly moving higher, meaning it is now slowly appreciating in value. Okay, and you can see that I think, yes, it is from this level you can think it's going higher. Yes, and at this level, since we have not passed this previous expensive level, at this level the price is still cheap. Okay, a bit, yes. And on this level, since we have now passed this the last expensive area, it is now getting what? Expensive. Okay, and when it got to this level, and you can clearly see that we've passed the previous expensive level, and for that reason you can now start to sell it from this zone. Okay, because it is now expensive. And when it is expensive, in other words, it means that there is more supply than demand for that asset at that particular time. And for that reason, the price will depreciate again in what? In value or price. Okay, this level, it is still expensive. Yes, a bit more lower and you can buy. Okay, and since we've got at least 50%, yes, we've retraced or we have corrected and yes, depreciate in value or price in at least 50%. Okay, that means if the price at this level was around 25 bob, hypothetically, okay, to this level it will be what? 75. Okay, and coming back lower, 50% of 25, let's say 70. Okay, 70 is what? 5. Okay, so this level is cheaper than this level. Okay, meaning you can buy. So since this is 25, next cheap level is what? 5. Okay, this we can say that this is 50. 50, it got to what? 25. Okay, and from 25 it got to what? 70, because it passed what? It passed the 50 level. Okay, and from the 70 level price, okay, it it lost its value for more than 50%. And so 50% of 70 is what? 35. So the lowest price or the cheapest price of this market or the gold bar is what? This level, which is 35 bob, and this level which is 25 bob. And when I ask the most expensive or the expensive price of this chart will be this 50 let's say $50 per gold bar and this $75 per gold bar. Okay, and it is on these levels 5 and 5 will buy. Okay, and it is this level 50 and 75 we look to sell. Okay, and so from 35, which is now underpriced, and we look to engage ourselves by buying, we anticipate that the price again will appreciate in value, and as the 75 bob yes, the $75 price range, and maybe push higher to at least $100. And that is how the price the price moves from a supply, from area of supply to area of demand where buyers buy, to another area of supply where sellers sell, to the next level of demand where buyers involve themselves by buying. And again, they involve themselves by buying in this market to push the market higher to to a higher price or the next supply area where sellers will now start selling the price to look for a cheaper price. Okay, and I think from 35 bob from $5 area, price still surged or appreciated in value, and it goes to we can say it $100 area. And for that case, if you involve yourself from 35 bob area to 100 bob, you've made around 65 bob. Okay, and from 25 to 70, you've made around 50. See, and that's how you make money in these markets, or you utilize supply area, supply area to sell, and demand area to buy and push the markets higher. Okay, yes, and I think if you have any other question on the dynamics of supply and demand, please feel free to ask the question. Okay. Yes, moving forward, price action, the market language. Okay, yes, like we said earlier, multiple candlesticks is what builds what is called price action. Okay, price action is just raw data price. It's unbiased. It's just price. Yes. Then, as traders, we apply technical analysis by analyzing patterns, footprints, structure, indicators, fundamentals, and etc. And we become biased towards the price. Yes, we either become a bullish buyer or bearish buyers, forming an opinion whether it is cheap or it is expensive. And in that case, if it's cheap, we look to buy and push the price higher. And if it's expensive, we look to sell and make the price differential when the price is depreciating in value. Okay. Yes. Now we are going to put labels on the chart, but before, yes, now I'll take you through how we can set up our chart specifically using TradingView. Okay, before we continue further, yes, just come on your browser, search TradingView.com, and you don't have to worry about it. I'll leave the link on the description below. You just search TradingView and it will take you. Okay, once it will take you to this area. You will sign up, and once you sign up, you find this page. Now we are going to launch the super charts. It is very simple. Yes, it's very simple to use this platform. Okay, this is what you get when we talk about candlestick price action. This is what we talk. Okay, now that we've set up our TradingView, yes, we have set up our charts on TradingView. You can add, yes, you can analyze any instrument that you want here. You can come here and search maybe gold. Yes, to this. This is the market without the label. This is the market after putting label on the charts. Okay, now this is how we analyze the market, by putting labels and identify where the next demand zone will be, where the next supply zone will be, high, next demand, high, and okay, demand, supply, demand. Yes, this is just of identity. This is just a sequence of identifying supply area and demand area, and it is on demand areas where we look to buy, and it is on supply zones where we look to sell. Okay, yes, moving forward, we've gone too far, but yes, I can introduce the backbone of the market, which is the market structure. And in the next episode, it's where we're going to, yes, we're going to dive deeper. Market structure, yes, market structure. Market structure, this is the breathing pattern of the market. Okay, I believe it's the strongest, it's the strongest foundation of every trader. Even if you don't trade market structure, still you need to understand it. Okay, it shows you who is in overall control, be it buyers or sellers, and what the trend is. Okay, the market is usually in one of two states. Either it can be trending or consolidating, and when it's trending, it's either uptrend or downtrend. Okay, bullish trend or bearish trend. And when it's consolidating, it's ranging, consolidation, or directionless. Okay, yes, our first job as a trader is to identify the trend and state of the market. Yes, I think on the hierarchy of technical analysis, or the pyramid of the technical analysis, at the bottom we mentioned that it is the direction or the bias of the market, and after it, so our job as trader is to identify if the market is trending downward or upward, or if it is consolidating. Okay, let's see how this is. Yes, the market structure masterclass. Market structure manifests in the form of structural pattern. Okay, for a bullish trend or an uptrend, we have a sequence of higher highs and higher lows, and for a bearish trend, we have lower lows and lower highs. The golden rule is an established trend is more likely to continue than reverse. Okay, and this dynamics of an uptrend is defined as structure that is breaking the highs and maintaining the lows. Okay, you can see that every time we print a high and the higher low, the higher high or the high is what is being broken. okay? But the lows or the low or the higher low are the ones which are maintained, okay? Now, whenever you see a high is being broken and the low is being maintained, you can definitely know that this is an uptrend, okay? Yes, previous or the last higher high will always be broken, while the previous low or higher low not be broken, always be maintained. The higher low is only confirmed when the previous higher high is broken, okay? This higher low, it can only be confirmed by a break of this high, okay? And the same, this can only be confirmed at the break of this high. So an uptrend has a sequence of high, higher low, higher high, higher low, higher high, higher low, higher high, higher low, okay? I think you can pause and look at this. Yes, maybe internalize it before you continue. Yes. In reality, it's not as simple as the schematic we drew earlier, okay? Real price action is going to look something like this. This is the low, this is the high, okay? In between this low and this high, there are going to be some sequence of lower low, lower high, lower low, lower high, but usually on lower time frame, okay? Before we get to the higher low, okay? And again, once we start to print higher highs and higher lows on the lower time frame before we break the higher high, yes, this is how the price will move. And again, after the break of this higher high, we call this a break of structure. Again, we are going to have maybe not something like this, but something like this. A break of structure, correction, break of structure, and then consolidation, then break of structure. So you have to be creative on how you will identify these higher highs and higher lows, okay? And specifically, low, high, higher low, higher high, higher low, higher high, higher low, higher high. Exactly like low, higher high, higher low, higher high. Yes. Identify this higher low, higher high, and we are only looking for this. Yes, we are only looking for this structure to at least depreciate in value to either around 50%, 61, yes, 50% or 61, and that's how we find a cheaper price to involve ourselves as buyers, okay? Now this is the main structure. All this here, it is an internal structure, and it is usually more visible on the lower time frame. We're going to see that moving forward. Yes, higher high, this higher high, this higher low broke this higher high, and the price cannot break it straight in a straight line, okay? It has to move in sequences, okay? And it is through those sequences you get the break of structure before printing a new higher high, okay? And as usual, after printing a higher high, the price has to move low and print another higher low. And as usual, this is an internal structure, okay? And as usual, internal structure is more visible on the lower time frame. Again, is this higher low which broke this higher high. This again, this is internal structure, and it is more visible on the lower time frame. Okay. And for us to make sense, this can be this main structure can be the structure of 4-hour, and this internal structure can view it more clearly on the lower time frame, which can be 1-hour structure or 15-minute structure. Okay. Now this is a real uptrend. See, since yes, to this low price put high in low to print a low. After this low, you can see that the price pushed ahead a higher high. Okay, you can take this or this, and again put and print a higher low, which again in return put a higher high, which again another higher low, higher high, higher low. That's how an uptrend behaves. Okay. Yes, the dynamics of downtrend. A downtrend is defined as a market structure that is breaking the lows and maintaining the highs. The previous low or lower low should always be broken, while the previous high in brackets lower high should not be broken. Or a lower high is only confirmed when the previous lower low is broken. Okay. High. And a downtrend should always breaking lower lows. Okay. Yes, after this low we printed a lower low. We then retraced and printed a lower high, which in return broke this lower low and printed another lower low, which again printed a lower high, which in return broke the structure of this lower low and printed a new lower low. So a downtrend through the breaking of the lows, it prints the sequence of lower low, lower high, lower low, lower high, lower low, lower low, lower high. That is well defined. As usual, every break of structure, there will always be an internal structure. Okay, so this is the lower high, lower low, lower high, lower low, high, high, structure. Okay, now you can see this is the real downtrend example. Lower high, lower low, lower high, lower low, lower high, lower low, high, lower low, high, lower low. This is lower high, lower low, lower high, break of structure, lower low, lower high, structure, lower low, lower high, lower high, break of structure, lower low, lower high, and yes, the sequence of lower highs and lower lows, lower highs, lower lows, lower highs, lower lows. Yes, moving forward now, let's talk about consolidation or changing. Consolidation is a market structure that is failing to break both the highs and lows or just weakening them. Consolidation is a balanced price action, an equilibrium, or a fair value. It is extremely important because that's where banks or big financial institutions are stacking orders and preparing for the next big move. Okay, see a consolidation. When you see a consolidation, just know BFIs are cooking. If you study the charts, you'll see how before and after every big move is always a consolidation, okay, or a continuation. And you can see that price has and resisted to break this zone. Retrace to this area again, resisted to break this zone. Again, finding a ceiling, finding a floor, finding a ceiling, finding a floor. You can see that there is no a clear direction for this. Okay? And on a higher time frame, consolidation can have multiple short-term trends. Okay, remember the market is factual. There are trends within a trend. So you can see that price has moved bullishly when it got to this area, consolidated, did nothing. Then again, pushed lower. Okay, and it did not break this barrier again, meaning that it is not printing a higher high, either is it printing a higher low or a lower low. Okay, it is bouncing between this ceiling and this floor, and this in between the ceiling and the floor, or the resistance level and the support area, there is usually a midline. You will always see price either consolidating in this between these zones. And yes, when you look at this chart, what do you see before we put labels on it? Yes, pause this video and try to label this before we move forward. Moving forward, this is the initial consolidation. You can see that ever since price got to this level and printed this low, it resisted to break this area, and again it came and held this support area. This was our midline, okay, but it was broken to the downside, okay, and you can see that this is a macro driven downtrend. And after that, you can see that there was an uptrend, okay? And this uptrend pushed us into what? Into a consolidation here, or price reached its equilibrium, okay? And it was on this area, the price broke the downside before again pushing to the upside. Yes, after after the bullish impulse, you can see that there is another consolidation. So after every bearish or bullish or a trendy market, you will always find a consolidation before continuation of bearish or bullish trend. Okay, a real consolidation example, price just jumping this resistance zone and this support zone, not breaking and printing higher highs, sequence of higher highs or lower lows and higher highs. Okay, yes, and you can also look at this choppy market price. This is a very rangy or consolidating market. Again, this is another one. You can also take all of this as a range between the red line and the green. You can see that price maintained it in this zone. So that is consolidation or consolidating markets. and we're going to leave it at that. And I think it's more than enough. And for the next episode, which will be episode 4, we're going to dive deep into the trend foundations. Yes, the market structure, how to identify them, and yes, we're going to continue with our series from there. And for anyone who is joining us who is new in this channel, yes, this is Traders Hub YouTube channel where we post trading educational content and weekly analysis. Please feel free to subscribe to our channel and hit the notification bell for you to be notified whenever we drop a new video. And since I'm done with our episode, see you in the next episode. Thank you.